huge job surprise jolts the rate cut story. Oil risk returns through Middle East tension. Euro inflation climbs further above target, and US PMIs flash a stagflation warning. Then the market's biggest leader finally cracks, the AI trade. This week's recap shows how jobs, yields, crude, inflation, and tech valuations turned relief into risk-off. Welcome back to the weekly market recap. The key shock hit on Friday, when the May jobs report forced markets to rethink the whole rate cut story. The headline was simple. The U.S. added 172,000 jobs in May, far stronger than the roughly 80,000 to 88,000 economists expected. That matters because payrolls are the cleanest monthly read on whether the economy is still hiring, still spending, and still keeping pressure on inflation. So this was not just a good jobs number, it was a number that made the Federal Reserve look less flexible. And when the Fed looks less flexible, yields rise, rate cut hopes get squeezed, and expensive stocks suddenly have less room for error. Start with the expectation range, because this is where the market shock begins. The low end was around 80,000 jobs. The high end was only about 88,000. Then the actual number landed at 172,000, almost double that upper estimate. The unemployment rate held at 4.3% for a third straight month, so the headline did not come with obvious labor market damage. Wages also stayed firm, with average hourly earnings up 0.3% on the month and 3.4% from a year earlier. The revisions mattered too. March and April were lifted by a combined 93,000 jobs, making the recent labor picture stronger than markets had thought. The hiring mix made the report harder to dismiss as noise. Leisure and hospitality added 70,000 jobs, a clear sign that service activity was still running hot. Local government added about 55,000 jobs, keeping the public sector side of hiring strong. Healthcare added roughly 35,000 jobs, another steady support inside the report. But financial activities lost 22,000 jobs, so the strength was not perfectly broad. The key thing is this. Enough sectors were firm to confirm resilience, but not enough weakness showed up to revive recession relief. Official Washington then became part of the market backdrop because stronger jobs, sticky inflation, and Fed pressure all run through policy expectations. After the report, the 10-year Treasury yield moved above 4.5%, while the 30-year yield topped 5% during the reaction. Stocks took the hit. The S&P 500 fell 2.6% to 7,383.74. The Nasdaq dropped 4.2% to 25,709.43, showing how hard higher yields hit growth stocks. The Dow lost 695 points to 50,866.78, and the next pressure point was already building in oil. After the job shock squeezed rate cut hopes, the next pressure point was oil. On June 1st, Middle East tension pushed energy risk back into the center of the market. The catalyst was concern that Iran had stopped exchanging messages with the United States over talks, raising fears around the Strait of Hormuz. The strait matters because it is a critical oil transit route. When traders worry about that choke point, they quickly add a supply risk premium. That means the barrel price is not just an energy quote. It becomes an inflation signal, a consumer cost signal, and a margin risk for companies. The key change was not panic everywhere. It was the market repricing diplomacy from easing risk to stalling risk. The cleanest proof was the crude move itself. Brent crude traded near $97.58 a barrel during the reaction, putting the global benchmark close to the upper end of the week's stress zone. U.S. crude rose about 5.5% to roughly $92.16, a move large enough to dominate the June 1st cross-asset tape. This is why oil shocks move more than energy stocks. Higher crude can feed gasoline, freight, air travel, and input costs. If oil keeps rising, inflation expectations harden, and central banks lose flexibility. If diplomacy steadies, the risk premium can fade before it hits demand. So confirmation matters. The next clue was whether crude held the spike or gave it back. The transmission showed up in rates and the dollar, not only in oil screens. U.S. crude was the starting point of the chain. The 10-year Treasury yield moved from about 4.452% to about 4.475% in the reported session. The dollar also found support from the mix of higher yields and safe haven demand. White House and Iran diplomacy therefore mattered directly to markets because policy headlines could change the oil premium quickly. Equities looked calmer on the surface, but breadth was weak underneath. 9 of the 11 S&P 500 sectors finished lower, even though headline indexes stayed positive. The Nasdaq rose 0.4%, the S&P 500 gained 0.3%, and the Dow added 0.1%. So the message was clear. AI momentum could mask risk for a day, but oil was already feeding the next inflation story. Oil had already put inflation back on the screen. Then Europe added its own confirmation. Euro area inflation reaccelerated on June 2nd. The May flash estimate showed inflation rising to 3.2%. HICP is Europe's harmonized consumer price gauge, so this is the number traders use to compare inflation across the currency bloc. The market problem is simple. 3.2% is not close to the European Central Bank's 2% target. That tells you rate cut comfort was fading, and the bar for an easier ECB message was getting higher. Now look at the comparison, because this is where the policy pressure becomes clear. A year earlier, in May 2025, inflation was 1.9%. The ECB target is 2%, so that older reading was basically in the comfort zone. By April 2026, inflation had already climbed to 3%. Then May pushed it to 3.2%, moving further above target instead of cooling. The monthly increase was only 0.1%, but the annual direction mattered more for markets. If the annual rate keeps rising, the ECB has less room to sound relaxed. If it rolls over, yields can breathe again. The components showed why this was not just a noisy headline print. Energy inflation was the hotspot at 10.9%, barely above April's 10.8%, but far from last year's negative reading. Services inflation rose to 3.5% from 3%, which matters because services can be sticky. Food, alcohol, and tobacco slowed to 2%, so not every category was heating up. Non-energy industrial goods rose only 0.9%, leaving energy and services as the pressure points. The geopolitical backdrop still mattered because energy pressure from the Middle East was feeding the European inflation story. Germany eased to 2.7%, but France, Italy, and Spain all moved higher, so this was not one country noise. For markets, that meant firmer euro area yields, tighter ECB expectations, and less confidence in quick disinflation. Next, the PMI data showed why growth and prices together became an even harder mix. Europe's inflation warning did not stand alone. In the US, business surveys added a rougher message, activity was expanding, but price pressure was still loud. On June 1st, manufacturing hit its strongest reading since May 2022. PMI means a survey index where readings above 50 signal expansion and below 50 signal contraction. The ISM manufacturing PMI rose to 54.0 from 52.7, beating forecasts near 53. That is a growth positive number, but not a clean market relief number. Now the factory side gives the first half of the problem. May 2022 was the stronger benchmark at 55.9. April 2026 was 52.7, already safely in expansion. May 2026 climbed to 54.0, confirming momentum was improving. New orders rose to 56.8, production rose to 54.3, and backlogs increased to 52.2. Employment stayed below 50 at 48.6, so hiring was still not fully confirming the demand rebound. The services report made the inflation signal harder to ignore. Headline services. PMI rose to 54.5, above expectations and stronger than April. Business activity hit 57.7. New orders reached 57.3. But employment stayed in contraction at 47.9. And prices paid jumped to 71.3, the highest level since 2022. For markets, this was the awkward mix. Demand was holding, but input costs were not cooling enough. If growth holds and prices stay hot, rate cut hopes weaken. If prices cool next, the soft landing trade can breathe. That is the setup as the next chapter tests the AI rally itself. After the PMI warning, the market's final stress test was leadership. The AI trade did not just cool, it cracked where valuations were highest. Big tech sank after the strong jobs report lifted rate fears. That is the key mechanism. Higher yields make long-duration growth stocks harder to justify, because more of their value sits in expected future cash flows. On June 2nd, records still looked clean. By June 5th, the tape had changed. June 4th looked like rotation, not collapse. The Dow surged 874 points, up 1.7%, to a record close of 51,561.93. The S&P 500 rose 0.4% to 7,584.31. But the Nasdaq slipped 0.1% to 26,830.96, showing pressure under the AI leadership. Small caps also joined the rotation, with the Russell 2000 up 1.4%. And Friday turned rotation into risk-off. The Nasdaq fell 4.2%, its worst session since April 2025. The S&P 500 dropped 2.6%, its steepest fall since October 2025. The Dow lost 1.3%, even after setting a record the previous day. For the week, the pain was concentrated in high-duration growth. The Nasdaq lost 4.7%, while the S&P 500 fell 2.6%. The Dow slipped only 0.3%, confirming this was leadership damage, not equal damage everywhere. That wraps the week: jobs, oil, inflation, PMIs, and finally the AI trade's first real crack. That is the market map for this week. Labor strength, oil risk, sticky inflation, and a real test for AI leadership. If you want the full technical map behind this recap, watch the linked weekly chart deep dive next.